Do you want to learn Elliott Wave Theory? Well, if so, consider joining the Green Star Trading Patreon at Tier 2 or Tier 3. You will unlock this playlist, 14 video part series teaching you Elliott Wave Theory from scratch in a simple and easy to follow manner. You'll also get access to other playlists such as the My Chart series showing you how to set up my chart the same way I do, with the same indicators and tools configured the way I use them. Also, I've now got a second series of this which will cover all of the classical analysis techniques I use. We've started with episode 1, part 1 and part 2, support and resistance, but we'll be covering volume profiling, candlestick patterns, indicators, all sorts of things to come over the following months. I also have my deep dive videos as well, which I'm now currently doing a second part of a new one which will be uploaded to here soon. And yeah, I also have a trading playlist showing you how to use the standard trade setup, the STS, and a little bit on psychology and risk management as well. You can unlock all of these things by becoming a patron today at either Tier 2 or Tier 3. There are some other benefits to joining Tier 3, or you can just support the channel at Tier 1 for a £5 a month. Either way, I'm not going to read it all out to you. Follow the link in the description box below of the video you're watching now. Come over, have a read for yourself, and if you want to sign up, please feel free to do so. I would always recommend signing up at the start of the month so you get a full month's value for your subscription before Patreon charges you again. Alright guys, let's get back to the video. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for another look at the SPY, which is our proxy for the S&P 500. We're going to be looking at the PCC and the VIX as well. Right then, so starting with our primary count, which is a bullish count, that we've finished a primary wave 2 correction and now in a primary wave 3, moving higher off to new highs in a larger fifth cyclical wave, then things look pretty good for the bulls. Now, on the note of saying bulls and bears, if we, discuss this analysis within the framework of bulls and bears, and we end up in a dead end pretty quickly either way, because there's no room for discussion. The bears are going to tell you that this is a bear market rally, and they might be right, and the bulls are going to tell you that the low's in and we're off to new highs, and they might be right. So what we're going to try and do today, as unbiasedly as we can, is work our way through the evidence that we have so far and see what supports each case, and that's really, I think, all we can do. Okay, so on that note, let's discuss my bias first, which is my primary count, and it's bullish. Now, that's what you're expressing. If you're saying to somebody this is a bear market rally, you're expressing a bearish bias. You can cite all the evidence you want fundamentally about why it should be happening, just as any bull could cite evidence to the contrary, and technical analysis either way for either argument. You're expressing some kind of personal belief, and in that sense I'm trying to be as unbiased as I can, but my personal bias is that the market has bottomed. Now, if it hasn't, we will break this low, we will invalidate that bullish idea, and we will go lower, and before that happens we will have alternatives in place to adjust our own personal trading decisions and outlook based on evidence, and that's all we can really hope to achieve. So a quick rundown of what I think is happening and why. Let's come down to the hourly time frame to try and fill the chart with as much data as possible. The first move down off of the high. Okay, I've expressed this before. I see this as 3. Okay, 3 waves. I do not see 5 waves in here to get a 1. I can see 3. I see no 4th wave relative to this, what I have as an ABC. This would be a 1 and a 2. I see no 3, 4 in this move down. What I do see is 3 larger waves, which could be expressed as a single move if we wanted to. I have not chosen to do that myself. However, if we were to try and express it as 5, which is the one thing that I think is lacking from the high, which any truly bearish case would require for the most bearish outcome, that is, I see an overlap. So we either have an expanding diagonal in here is the only way we could get down lower, and a leading diagonal of that it would have to be. So let's just put that to bed for the moment. Right, so this would be 1, this would be 3 here, that's 2, that's 3. 4 is obviously deeper than the 3, so now the only question is the 5 longer than the 3? And the answer is no. So it's not a leading expanding diagonal. It does not break the rule. It does not follow the rules of the 5th being longer than the 3 being longer than the 1, the 4 being deeper than the 2. So we can't force a diagonal in here. And I can see 3 waves. So my preferred choice is to divide it as I see, which is as 3. I then see this is 3, this is 3, and this is 5. Finishing higher in the C wave of a flat with an expansive B. So we get an expanding flat pattern for an X. So we've gone 3, 3. The best way I can subdivide what comes next is also once again as a 3 wave move, which I feel is quite clearly what it is. Now we could disagree, that's fine. If you want to force 5 waves in here, that's fine. But if you are going to force 5 waves in there, you need to have 5 waves here. We do not retrace 90% in an upward move. We do not expand to a new price extreme. So we do not get a 5-3-5 flat pattern. The only choice you have is a 5-3-5 zigzag. And with the inability to get a clear 5 off of the high here, I can't say 5-3-5. And so I'm going to say 3-3-3. W, X, Y. It's 2 zigzags, one here and one here. A W wave zigzag and a Y wave zigzag joined by an expanding X wave flat. That's how I see it. So before we move on, let's discuss, before we talk about this bit, let's discuss what that can potentially mean. Now 3 waves is a corrective structure. So we are either done here, which is what this count assumes, or we have simply started a larger corrective structure. So what are the options? Well, there's only 2. We have either put in a W, whether it's part of a larger WXY or a WXYXZ, we've put in a larger W here. Alright, and we're going to have a zigzag here, comprised of a WXY, so a double zigzag in a W, and then we're going to have another corrective wave, and then another corrective wave. Could even be a combination of a zigzag perhaps into a flat. That's a possibility, or a zigzag into a triangle. It's also a possibility. It would be a combination after all, and not itself a triangle, which would not be allowed in the wave 2 position, only in the wave 4 position. So rampant speculation available there, and an infinitely larger pattern yet to complete. So very little value from an Elliott wave perspective in terms of analysis. It's too bigger an idea. It's too bigger an option. So the next one would be a flat pattern. We've had 3, so we can have 3 in a B. Now we would expect the B most of the time to expand to a new price extreme, to a new high, and then for the C to come lower than the A. So an expanding flat, it could be a running flat, it could be a regular flat where the B does not create a new price extreme, but let's assume for a moment that it would be. Then the best way to interpret any move off of the low would be as 5, 3 and 5 to get a zigzag to a new high, and then we could get 5 down in a C, possibly making a new all-time high and then collapsing. These extend the correction out in time. Okay. The purpose of the WXY in itself is to extend price lower, and I would argue that's exactly what it did. The first zigzag was far too small, the second zigzag made up for it in spades. Now if we were expecting another double zigzag with a double zigzag within the W of a larger double zigzag, then what are we saying about what we're expecting in the second part of the correction? We can either spend time sideways using a flat or a triangle part of the combination, or we can have another zigzag lower, perhaps just a simple ABC. See, that all seems a little unnecessarily convoluted. I'm not saying it's impossible, I'm just saying there are simpler assumptions we can make first, which could be tested and can be broken to confirm whether or not they are correct. So let's go with the simple first, and the simple is 3 moves to a low. That's it. Done. So what supports the idea that it's done? Well, let's just hide the count for a moment before we consider this bit of a low, because we'll count this separately. So let's take your standard original pitchfork. So we're going to take the top pivot, hit the top, and then we're going to take this pivot and this pivot. Okay, this is based on my Elliott wave count. Right, so W, X, and Y. We can see that we test the median line. Well, we actually come down, test the outer bound, test the median, test the outer bound, head back towards the median, head up, back to a golden zone, up to the outer zone, outer bound, back again, and then break it, and then back test the outer bound on the way out of here. And we test this extreme outer bound for support as well. So the trend off of this pivot is broken. So that confirms, for want of a better word, that whatever we've done in this initial move down is complete. So if it was an impulse, we could say 1. If it was 5, also an impulse, we could say A, right? Or we can all say A, and then B, and then C for that flat. Or we can simply say 1, 2. This is all complete, and that's why we've broken that structure. But whatever this was, whether it's a subwave of a larger structure or complete wave in itself, geometry suggests that it's done. Okay. Whatever form it's taking, A, 1 into 2, WXY, suggests that it's over. Now we could position that pivot in different places. For example, we could take this pivot here, using the dominant pivots rather than the Elliott wave pivots, and we can see that we get back tests of the outer bound again, the 61.8. I'm sure if we put this into a full pitchfork, we'll see tests of the 23.6 as well as we have here, and back tested as well, and the 78.6 and the 89. It's all in here, and that suggests even if we take that pivot or that pivot, whatever we're dealing with here, completed here. So whether it's a completed subwave or a completed correction. So now we need to be looking at this in one or two ways. We need to be looking at this as either an adjoining piece to another move down or move sideways, or we need to be seeing this as a new bullish move off of the low. That's what my primary suggests, that this is a new bullish move off of the low. Right. So now, what other evidence do we have to support the idea that this may have completed down here? Well, the strongest one I feel is if I bring up my VIX and PCC extremes. I marked the extreme reading we had here on the 17th of June 2022, just like I did back here on March 20 of 2020 as a PCC extreme reading. So if we go over to our PCC chart here, we can see that on each of these readings we come up. This is back in 2012. We come up to these highs, descending trend line into extreme fear and panic area, just like we did here in 2019, just like we did here during the COVID panic in 2020, and then we head down into a period of greed and complacency. Well, we got a bump of that trend line back in extreme fear and panic readings, well above the dash route bound here, not quite into the most extreme conditions, but into elevated conditions. Okay, we pull in a high, and now we're breaking trend. Right, we're now heading down lower. Now we can do something like this. Right, we don't have to come down in one go. We see here that this is a free wave move back to a high before coming down. This was a much more gradual, much more steeper breakdown, and this was a more gradual grind down. So we're not necessarily just going to go back to greed and complacency, right? If we've got a larger wave to play out, these things take time. And if I'm suggesting that we're entering a wave 3, that means a 3, a 4, and a 5 to come. And if you look at the time period between these periods, you've got 825 days in order to go from extreme fear to extreme greed. You've got from high to low here 872 days to do it, and then from here you've got 794 days. They're all in that 800 day-ish region. So let's say we go from extreme fear conditions this time to extreme complacency, and we get the same kind of period, right? And we stretch it out 800 odd days, we could be looking well out into 2025-26 or further before the market actually tops at a cyclical wave degree. So that's a very bullish way of looking at things, no doubt, but we have evidence to suggest that we've reached another extreme, and these highs don't tend to hang around long, not in the immediate term. They tend to break down quite quickly at first. Okay, so can we expect the same to happen again? Perhaps we will reach a snagging point at a larger wave degree before continuing. I have no doubt about that either, but we have strong evidence here to suggest that the market did indeed bottom at this extreme PCC reading. Okay, so let's come back to the chart for a moment. Okay, so now that we've discussed the PCC, I will timestamp that because I don't think there's any need to go back to it now. Let's look at the count off of the low and see what we can see here. So let's come down, let's stay on the 1 hour chart here and show you what I've got so far. Now, I've not convinced this is the correct way of interpreting it, so we're going to look at it two different ways. Right, so first things first, let's come down to the 30-minute chart here. This is one way of interpreting it. One way of interpreting it off of the low. That we've had a 5-wave move into a flat to get a 2. And then we've had a 5-wave move into a 3. This is one way of looking at it, and this should be a sharp correction. We could argue that it's a very short and sharp correction and it's already over. A zigzag taking far less time than the large flat here seems a little hard to believe to me, and therefore I would suspect that if this is a move and it was 5 down, then we'll have a B wave, then we'll have a further zigzag, and that will be your 3 and your 4. So in this case we're going to need an invalidation point for our wave 4, which is here at 393 spot 16. So that's the first way of looking at it, that this is 1, 2, 3, 4, 5. This is a sideways correction, this is a sharp. So in that instance, assuming we've got a high here, let's take our pitchfork for a moment, our original pitchfork, and we'll line up a 1, 2 pivot here as an original pitchfork. I just want the median line. Now what I find interesting here, we come up to the median line, we come up to the median line. Okay, I could place it here, but I'm going to take that high. Now what I've noticed here is we finished pretty much at the median line and we've broken the major part of the pitchfork. Right. I would normally expect to see the third wave, not always going to be the case because we have a second method of measuring Elliott's channel, which is from the 2 and the 4, but I would most of the time expect the 3 and the 4 to remain within the pivot set by the 1 and the 2. That's already broken here. So that leads me to think that there must be an alternative interpretation, that this is actually the 5th wave and the first wave 1 off of the high. So if I just take a channel to stress the point, let's take the 1 and the 3, project it from the 2. You can still see we are still in an Elliott wave channel. Right, so it is possible to go A, B and C. Right? Now we're going to have to do it pretty sharpish if we're going to set another low, which is what we'd expect to see, the C to go beyond the A. Right? Doesn't feel like there's quite enough room. Now it could be a double bottom and the C only just extends and we get a bit, not a truncated C, but we get a shorter C than an A, we get an extended A. All of these are possibilities. There's also the possibility that we'll be lining it up off the 2 to the 4 from the 3 to find the 5, and the second methodology is the correct methodology. Point being, we cannot break this invalidation point here of 393 spot 16 either way. So we could end up with a deep sharp 2, sharp 4 here as a sharp correction. Right. But as long as we don't break that 393 spot 16. So now that we've discussed that, let's just repackage this for a moment and grab these ones together. This one and this one. Yep. I'll put these in a separate folder just for the moment so we can turn them off and turn them out of the way. And we'll say count 1 off of the low, and we'll take that one as well so we can hide it out the way. I can always add this back into the large count. And then let's turn off that invalidation point, because we're going to work with a separate idea here. Either way, regardless of which one we're talking about, the bullish invalidation point for the whole idea off of the low is here at 362 spot 16. So alternatively, how about we do some measurements? So we're going to take this as the primary pivot, the 1 from the 2. We get a 1618 target here. That's a typical place for a 3, but we also get the 123.6 and the 130.18 here. That could be a position for a 3 as well. So there is the alternative idea that we've gone 1 and 2 as before, but then we've gone 1, 2, 3, 4, 5, 3, 4, 5. Okay, so that we've got 5 waves complete in here. Now, probably not as pretty, admittedly. Smaller wave 4, larger wave 2. It looks a little out of sequence in time, but there is enough subdivision here to make it work. Like so. Like so. Now that whole thing could just be subdividing as a larger 3. I feel that's a better look. However, whether we finish here in a 3 or whether we finish here, we don't finish at the 618 either way. So it's not an ideal ABC as an extension. It's not an ideal 123 as an extension either way. So, but that would be the alternative idea. In which case, we've topped out here at the edge of our channel. So 1 into 2, 3, 4, 5 to come. This would be a larger wave degree at minute degree. And therefore our geometry for this now makes a bit more sense. We finish at the median line for a wave 1. We break the geometry in our A. We back test it with our B. We complete its break with the C to get our sharp correction for the 4. Okay, or in this case, 4 in the other count, 2 in this count. We break all of this structure and then we head off in the 3. So that would be the alternative count. From that perspective, we'd be looking for support on the way back down. Okay, so let's throw up a volume profile here. So we can see how we've come straight back into this little demand zone. We've come up, we've fallen back, found buyers, up, found buyers, up, found buyers. So this whole area here, this is demand. Right. And we've come back into this currently and we're moving higher again. So we found temporary support. All of these highs represent support in the shorter term as well. So this is a support area and a little demand zone we've got going on. Not the strongest because it's on a smaller time frame, but it's there nonetheless. I'm going to get that right in a moment. There we go. So we're in this little demand zone. We've got support around this area here. 14, 13, spot 33, 14, 13, spot 20 in that region. We've also got another little area down here. This is a little demand zone as well that we could come into to find support. And then of course we've got support and resistance around here as well. So we've got previous highs. This is resistance, resistance becoming support, support. So this is another support zone as well. Okay. So now let's run up and let's put a little price on there as well because we're looking for support on the way down. I'll tell you what, let's be precise. Let's correct these. All fingers and thumbs today. Alright, 54. And let's run a fib from the low to the high and see what we get. Golden zone is right around these support levels. 50 is in above, so this whole demand zone here with this price support is between the 61.8 and the 50. So this region here, highly probable area for support. Highly probable area for support. Now the rest is speculation. Now let's take an assessment of what we'd expect for a B wave. So anything from the 38.2 to the 50. So if we take our wave 4 setting here and we work on the idea of, well, it's actually 38.2 to 78.6 is the most typical. So here's 38.2. 78.6 is going to be about here. So let's go A into here. Right, A, B into here, C down into our target zone. And let's see what kind of luck we can get for a 1-for-1 parity. So 1 from there. There's the B there. That goes down below the A, but that seems to not go very deep. So let's take it from the 38.2. Now we come into that demand zone. 123.6, 131.8 in that demand zone as well. If we come up to the 50, very typical retracement for a B, the 100% extension of the A from the B is right at the top of that demand zone, right around this prior resistance, which will now be support. The 23.6, the 31.8 and the 616 all go between the 50 and the 61.8, reinforcing the idea that this is a very strong area for support. Okay, so I hope all that made sense. So that supports the secondary count. Now I don't honestly think I have a favourite at the moment. Measurement wise, retracement wise, geometry wise, I think I prefer this. In terms of the actual look of the wave degrees, I think I prefer the idea that we're in a 3 going into a 4, in which case we won't go as deep. Okay, so I'm just going to save that as a separate idea now. And we'll say count 2 off of the low. Like so, we'll save the chart. Always a good idea. Okay, so now let's zoom back out again. Right, we've seen what we've done from below now, but why have we come to where we've come to? So let's zoom back out and get a look at the bigger picture again. Right, so let's bring up our longer term support and resistance folder, which is there. Right, so prior resistance 426.55. In other words, this area, let's just zoom in a little bit, this area here, we had 3 rejections all at this level. This was around prior support, prior resistance, prior support, okay, and we had these 3 rejections in this region where the price came up, found sellers, and then moved lower. Moved to a lower high, then to a lower low. We've now broken that pivot. Okay, this is a sequence of low, higher low, lower low, lower high, lower low, now higher high. Okay, so we've come back above that level, but we've come into this previous resistance around 426.55, and we found some supply up here. As we should see, we came into this region, we fell back, and then we could easily label that supply zone, as this is where we came down, retreated, and found sellers. Right, and that's where we've come to. So you can see we've come to a pretty stubborn resistance point, essentially, resistance level. So yes, we've done enough for this to be a 1 into a 2. We've got a count to explain it. Yes, we've done enough for this to be 1, 2, 3 into 4. We're at a point now where we simply have 3 waves complete. In the ideal bullish scenario, we may have 5, like I discussed, but in the ideal bullish scenario, we would want to see clearly 5. Nice time difference between the two, similar, you know what I'm saying. It looks like it belongs. It has the right look, the better look. 5 up from the low looking like this, you're bullish all day, right? Because that means correction and then a guaranteed 5 higher, whether it's 5 into a larger 3 or 5 into a C of a B, C. You're getting another swing higher off of a 3 wave retracement. The market's just being ambiguous. It could be enough, it might not be enough. It very much represents how most people feel at the moment, unsurprisingly, as it's made up of all our emotional responses. So we're seeing a wave which could be 3, it could be 5 incomplete, or it could be 5 complete, but it doesn't want to make you look, it doesn't want to look that way. Okay, and that's just the way it is at the moment. So the best we've got is to tick things off as they come to us. So if we take the count 1 off of the low, this gives us the wave 4 invalidation point, 393.16. If we start to break down in a zigzag, okay, we see 3, so we see an A, we see a B, we see the beginning of a 3. We're either going 1, 2, 3 down, which will break this level and we'll go to new lows, or we're seeing the expected sharp correction as an alternation to this flat. But it will break down at this level, 393.16. Go through that, this count is off the chart. If count 2 is correct, and here's the bitch, we have to kind of break it. We don't have to break it, but we're going to get bloody close to breaking it, if not break it, in order to get a wave 2. Between the 50, the 61.8 and the 65. Now the best we can do at that point is the original invalidation point off of the low. So let's just bring that back up. Have I deleted that? Or is it part of a larger count? Bear with me. Here it is, which is 362.16. So looking for support as we come down into these levels. But the ideal now, this count or the other count, the ideal for the bulls is to take out this high. Okay, because if you do it in the shorter term, it's going to look like 5 waves up. If you do it in the longer term, then you swung from a lower correction and now you're off into another move higher, either a C or a 3. Okay, so a move through this level and higher is confirmation of a bullish structure. whether it's a zigzag into corrective B or whether it's a 1, 2, 3 higher. So taking out that level is what the bulls really want to see. Whether they do it in a few days' time or whether they do it in a few weeks' time, that's what they want to see. The bears would really prefer this to hold in the shorter term. It's not going to matter so much in the longer term because it depends on your outlook. If your bearish is in, why is the market going higher, this making no sense, then yes, you would definitely prefer it to stop here. If you're a little bit more open-minded and you accept the possibility of 3 to here, and then 5 down, then we're still going to make lower lows in the end. It could just be a long time coming yet. Right, so for me, there's 2 corrective counts which lead higher off of the low, and there's 1 bullish count which leads higher off the low, and I can't perceive any count in the short term which takes us to beyond this low that's solely bearish. So I'm going to have to lean bullish either way at the moment. Okay, and that's just the way it is. Something might come up that I see that I can't see now, but for the moment, corrective or impulsive counts seem to want to lead higher. Okay, so we'll stop there for a moment. I'm just going to have a quick sip of my coffee. I hope I'm making some sort of sense. Right, so we talked about bullish counts. How I can see a corrective move higher where it takes us higher, whether it's an X wave or whether it's a B. There's 2 counts there which lead us higher, or whether it's bullish, that's another count which leads us higher. I've mentioned that, hence why I've got this bullish bias. However, that does not mean that we can't go lower from here. We just need to find a way of expressing it. We need to find a way of explaining it. So let's see what I've got here in this folder. Now this is a WXY, X and Z. This is, I labelled it new alternate. Now let me explain what I like and don't like about it. Okay, we got a break in geometry. Okay, let's just use a regression channel for the moment. From the high to the low. We got to move down, move back. This is 2 standard deviations from a mean. W to X to Y, right? Channeling nicely. It's odd, very odd, if this was a part of a double zigzag, that this overall structure, which is the same wave degree, would subdivide like this. Now, if it was breaking down into a sideways correction, right, a flat into a triangle, for example, then getting these swings to much further back, and that would make sense. But if it's just a zigzags, so zigzag, zigzag, this doesn't really look right to me anymore. I'm not saying it's impossible. I'm not going to say it's impossible. The fact that the X has come back beyond the W, that's peculiar. Right? That doesn't really show the purpose of this pattern. The purpose of this pattern is to keep in each zigzag, in each successive zigzag, is to push price lower. Why are we getting such a deep X wave if that's the purpose of this correction? Surely a simple zigzag would have sufficed. Right. So, I don't make the rules, and the market psychology can get so screwed up sometimes that maybe more complex structures like this are more normal, I don't know, nowadays than they used to be. But either way, W, X, Y, X, Z. So, very extended C in the X wave, which does not come to a typical 161 target, as we discussed, because we were looking at it as a potential 3. Okay. Big disparity between A and C. More likely to be 1 and 3. But I'm not going to write it off. In this case, we will not make a new high. This will all be 1. This will be 2, 3, 4, 5, into an A, into a B, into a C to get the Z. Triple zigzag. That seems to be the best I can make of it. Now, there is one other alternative for a bearish pattern, but I like it less than even that. And that's the idea that it is a possible, I said here, possible diagonal. And it's a leading diagonal, but it subdivides as zigzags as opposed to impulse. Because like I said, getting 5 down here, you can just fuck off with that. Okay, I think you're not looking at it right. If that, I'm not attacking anybody. I'm just saying that's 3 goddamn waves. Okay, and that's 3 waves. So if we're going to look at this as threes, then maybe we can look at it as a diagonal. We still have the problem of trying to get 5 in this initial move down, but maybe you can squeak something in there. I don't think you can, maybe. Alright, and in which case this is A, B, C, A, B, C into 1, A, B, C into 2, A, B, C into 3, A, B, C into 4, A, B, C into 5. Now what the hell does all that mean? Well, what it means is you've got a leading expanding diagonal. 4 is deeper than 2, 3 is longer than 1, 5's got to be longer than 3. So a target for 3, 4 is in. Right? We've got to go beyond 330 on the SPY. Got to get beyond 330 on the SPY in order for this to be a legit structure. Now let's say it completes. Right. So what are we ending up with at the end of the day if it's over, if it completes? Well, it's not a singular completed correction. You started with a motive structure, so you've got 5 down into A. You're going to have a mighty retracement for your B, because diagonals tend to produce aggressive retracements. Not all the time, but let's just give it the benefit of the doubt. It cannot come to an all-time high. It could come up to within 99% of it, but it cannot come beyond 480. Right? Cannot come. It's in that region, the all-time highs. I'm not being precise, but you see what I'm saying. You can't come back beyond that, and then you get your C. Now this is Armageddon kind of territory at this point, right? Because we are talking a big style correction, and if they're leading with an expanding diag because of uncertainty, the bulls keep trying to rally, they push back into previous price territory, then it's highly likely the C will be an impulse, right? Diagonal alternating into an impulse, and an impulse is likely to be far more aggressive. So at that point, you're talking like a total meltdown of the market, like a proper 1929 to 1932 kind of gig. Right. That's one of the only other counts I can see, and I don't like how it subdivides. Alright, so I'm just going to have to say not very likely, but I'll keep it on. I'll keep it on as alternative. A far simpler alternative is this, WXYXZ, just with a rather deep secondary X, which seems to just be a bit off, or we've bottomed. And just go back through all the levels I mentioned when talking about the bullish counts, because I think we're done there, guys, with the SPY. There's nothing else to discuss now. That's how I see things, essentially. So let's just look at some classical analysis now for the moment, the weekly time frame. Let's bring up our indicators. So, other evidence that it's bullish. We're going all the way back now. Overbought to oversold on the weekly time frame is often synonymous with the market creating a low. Overbought to oversold, what I like to call a round trip. Overbought to oversold back in March. Overbought to oversold back in December 18. These are all major lows. Market bottom, market bottom, market bottom. Right. Same here. Overbought to oversold into the lows of 2015 on the weekly time frame. And of course back here in 2006 all the way down. Big divergence at the highs into the lows of 2008 major market bottom. Reaching oversold conditions on the weekly time frame is synonymous with a market bottoming. It doesn't mean it has, it's just a very frequent historical occurrence. Matching that up with our PCC, looks like the market's bottomed. Give it the benefit of the doubt, or I'm giving it the benefit of the doubt. Bullish crossover on the weekly time frame of our average through the signal here. Not quite back in bullish territory above the zero bound yet, but this is just a wave 1 perhaps. Remember, wave 2 and wave 3, or maybe it's 3, 4, 5, 1, 2, 3. We will, if it's bullish, get back to trending above the zero bound in positive territory again. We want to see overbought conditions on the weekly time frame as well, going back from oversold back to overbought, and then we want to trend in the overbought, or we want to trend in the positive region on the daily time frame. Right, on the daily time frame, we saw oversold conditions. We've come up to overbought for the first time since November 2021. That's very strong reading off of the low. Very strong reading off of the low. Supports the bullish thesis over the bearish thesis. Same with the momentum in the MACD. To swing higher in this dodgy X wave that we're talking about potentially above all prior moves in our momentum indicator, going all the way back to June 2020, seems a bit bloody unlikely to me. Okay, now I'm not saying it's impossible, it just seems unlikely that that bullish momentum off of the low is corrective relative to all of this melt up kind of move that we saw before. This is very strong momentum off of the low. Still got its work to do on the larger time frame as we saw on the weekly chart, but still looking very strong. Okay, now let's have a look at our moving averages. So we broke the 250 exponential daily moving average here. Here was major support, resistance, broke through it, back tested the 60, fell lower. Moved back above the 60, back above the 250, bringing the 10 and the 20 with it. Haven't got our golden cross yet of the 60 through the 250, but if we're working on 5 waves up, what does Tom often say about a golden cross or a death cross? If you're looking for a higher high, the 60 through the 250 could well signal the high. Now whether that's B or whether that's just first wave 1, back into a 2, and off we go in a 3, we haven't seen it yet. Haven't seen it yet. Right. So we're still just stuck with 3 waves at the moment. Alright then, so I think we've covered everything here. Now we're just going to finish with a quick look, just a very quick look at the VIX. Okay, so this is the only thing I find a little peculiar. Right, I've mentioned it before. When we look at the PCC lows and the long-term RSI market bottoms, they link up very nicely with heightened levels in the VIX. Heightened levels in the VIX. So we did get into this little territory again. Okay? Right. Just like we did here, but it's not an impressive bottom like during the COVID panic, the GFC, or any of these prior completions. This being the exception, which was the temper tantrum in 2018. So we can bottom the market at these lower levels in the VIX. But given the size of the sell-off, you would have thought a bit more. You would have thought a bit more volatility. Honestly, you would have. And it hasn't really materialised. So that's the only thing missing. If I'd seen another spike up, combined with the PCC high, combined with the oversold weekly conditions and this kind of rally off of a low, I would have been that little bit more confident that the market had done all the damage it needed to do. The VIX here suggests to me that it hasn't quite done enough damage for a proper low in the markets to have occurred. So I guess we'll wait and see. Obviously I put my neck out today saying, putting forward a very bullish case. I could be wrong, and if the levels break down and we don't get the count to materialise the way we'd expect, I will flip bearish again. And there's opportunity always to trade it to the downside if you get the setup anyway. So we mustn't run away with the idea that it has to be bullish. It's just my preference currently. Alright then guys, we're going to leave it there. Thank you very much for joining me on this technical analysis of the stock market, PCC and the VIX. I hope you've enjoyed it. If you're new to the channel and you've liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. As always, a huge thank you to my Patreon subscribers. If you're interested in joining the Patreon and getting the assets that you want covered, the assets that you would like to see, the best way to get it is to join the Patreon, ask me to cover it in one of the weekly live streams or to give you a chart for it, and I will get back to you. Consider signing up at the start of the month. There's a link in the description box below. You can head over and have a read of the various tiers on the Patreon page. And if you're not following me yet on Twitter, the only reason I use Twitter is to post updates about YouTube videos. I'm not interested in tweeting really, to be honest, but just to make sure that you don't miss your YouTube notifications, you can follow me on Twitter as well. Alright guys, take care of yourselves and I'll be back with you as soon as I can. All the best, bye bye.